Hello, everybody. Welcome to the Women in Banking and Finance Distinguished Speakers event today. My name is Vivian Arts, and I'm the President of Women in Banking and Finance. And it is my absolute privilege and pleasure to welcome Saunders Calvert, who is Head of Sustainable Finance, Lipper and I&A Insights at Refinitiv, to join me today. Leon is actually a colleague of mine at Refinitiv, where I'm the Chief Privacy Officer as well. And so I'm doubly delighted that he is able to support this WIBF event on environmental, social, and governance issues, as he is our internal expert. So today we're going to talk about what is ESG, what are the driving factors behind this trend, is it a fad, or is it actually going to last, and who better to ask other than Leon? But before we embark on our event today, I thought I'd just run through a few housekeeping matters with you beforehand. So first of all, the event today is recorded, so you'll be able to download it afterwards. Secondly, everyone has been put on mute so that we can ensure that the sound quality is good, but the mute will be lifted when we get to Q&A at the end. Please could you submit your questions at any time? They will basically go into the chat functionality and then we can access them for Q&A afterwards, which will be great. And then the way in which we're going to run the event today is that I will introduce Leon. He will then present to you his area of focus in terms of ESG, and then we will follow that with some questions that I certainly have for Leon. And then open it up to the broader Q&A, and then we will finish promptly at 2 p.m. So to start off, as I said, Leon is the Head of Sustainable Finance at Refinitiv. He also has a range of board roles. So he is a board observer at TAB. He's on the advisory board of Aid Hub, and he's also on the advisory board of Highcastle as well. So he's a very engaged and involved expert. And I'm going to ask Leon if you wouldn't mind to present to us and explain about ESG, sustainability, and what we've been doing at Refinitiv to actually dig deeper and to support the financial services sector in this evolving area. Thank you.
Sure, thank you, Vivian. I'm very happy to. Thanks for having me here, everyone. So let's skip over a slide. We don't need to see my face. That's great, thank you. So let's get straight into it. I guess I would sort of highlight that there are probably two main core themes. They're certainly not the only ones, but they're probably the two prevailing themes which articulate really what sustainable finance is driving it to accomplish. The first of which is essentially financing and allocating capital towards the global decarbonization of the economy. The challenge, of course, that we have associated with climate change and global warming is essentially because there is far too much GHG, global greenhouse gases, in the atmosphere, and the concentration is too high, and so the temperature rises. And we need to reduce that level of concentration. The easiest way of doing that, really two ways of doing that. The easiest way of doing that is reducing the emissions which go into the atmosphere, the amount of emissions, and so tracking emissions is very, very important. And of course, the second one is actually to pull carbon and potentially other GHG gases, but certainly carbon out of the atmosphere. That's non-trivial, it's not easy to do, so it probably needs a combination of both those things, and certainly carbon emissions reduction is critical. And of course, there's an expectation that companies globally start to demonstrate in a much more tangible way, particularly in the sort of post-Me Too and post-Black Lives Matter world, that companies themselves demonstrate the sort of values of the open society, if you like, demonstrate that they drive for equal opportunities, that they practice what they preach around those things, and essentially that they behave and live as we expect societies to live in the modern democratic world. And so we move away from this sort of male-dominated and sort of relatively limited in terms of diversity sort of group of people that tend to run the economy, if you like, and that gets opened up from both a gender perspective, but also a race and ethnicity perspective, and that companies can be tracked on how well they're doing in that space and how well they're representing the actual demographics of the countries in which they operate. So those are probably the two biggest themes. I don't want to imply that that's everything, but the two biggest themes of what sustainable finance is looking to accomplish. If you move us on a slide, that would be great. This is a nice busy slide. Don't worry, I'm not going to talk for too long about all of the different text on here, and the slides will be shared with everyone afterwards for further review. But I think it's fair to emphasize that sustainability is not a new concept in financial markets. Sustainability, idea of sustainability has been around for a very, very long time, but there's been a fundamental shift really on two vectors over the course of the relatively recent past, the last few years or so. So sustainability always used to be thought of just, can the company on a relatively near-term basis continue to generate dividends and continue to generate cash flow and drive share price up and things like that. So really the couple of vectors that have changed is one, the longevity, the period of time over which we might now be looking at the company performance and the likely indicators of long-term company performance, not just short-term company performance. Secondly, I guess, is this idea that there are other data points which are important factors in understanding that, which are non-financial in nature, which are what we tend to refer to as ESG, environmental social governance data points. ESG is can also be thought of as just material non-financial data indicating with good indicators about company long-term performance. Of course, the UN SDGs have helped really drive the mainstreaming, both sort of in the commercial world, but also actually just in our everyday lives, around what we think sustainability looks like and what it means. And there were a few UN Sustainable Development Goals which most obviously lend themselves towards companies being able to solve for in a more direct manner. Some of the UN Sustainable Development Goals lend themselves more obviously, not impossibly, for companies to direct capital around, but some of them lend themselves more obviously to countries to solve for rather than companies. And you can see on the right hand side this massive growth in assets under management. That's what AUM stands for on this chart, assets under management. In terms of institutional finance, the amount of assets which identifies itself as sustainable, as focused on ESG or socially responsibly investing in some way, shape or form. How good a job it does is a different issue, but certainly that it self-identifies as being about sustainability. You're now looking at approximately a third of assets under management which self-identify in that regard. Let's move on a slide. So there are a few key drivers of change, and maybe we'll touch on this in a little bit more detail, perhaps in the Q&A, but very, very quickly, there's obviously this general acceptance of climate change, which, we as a whole, society as a whole, recognizes and is sort of scared about and wants to address. And of course, companies are no different in that respect. They're made up of people who care about those things. And so that's become more and more a central part of how investors think and how companies think. You've also, got what I would describe as massive regulatory overhang on the market. There is regulation coming. Some of it is well known, such as the new EU taxonomy, the green finance taxonomy, which is coming into play by the end of the year. And some of it is sort of still to be determined, quite frankly. But nevertheless, the EU taxonomy is going to be, largely speaking, the first major piece of regulation associated to sustainability. As it pertains to companies and financial markets. It certainly won't be the last. There's a sort of a growing demand as a result of this sort of generational shift that we've seen as millennials start to get their hands on enough money to be able to actually afford savings and put money into pensions and things like that. You've got this focus that millennials seem to have. It's certainly a generalization of an entire generation here, but seem to have a much more focus on what's the purpose of their money, where's it being deployed to, and asking all these kinds of awkward questions which the wealth managers and IFAs never had to answer before. And so need to be able to focus on how you respond to those questions and how you track data associated with it is super important. And in the asset management space, in the investment management space, you've had over the last 10 years or so this massive challenge in which active managers, people who actively decide where money is allocated, between which securities, which companies is money allocated from the pension pot or wherever it may be, that you've seen an enormous shift towards passive, so tracking investment strategies which track indices and benchmarks and similar in order to be able to drive returns back to investors, and a move away from active managers where typically there's more expense for active managers. But ESG and factoring in ESG criteria into the asset management process, into the allocation process, is a real driver of adoption by the asset management community. As a data provider, as Refinitiv is, Refinitiv, of course, one of the largest market data providers in the world to financial services, there are a few implications for us, which I've sort of listed along the bottom. You've got this greater drive for transparency and disclosure and reporting standards. We'll come back to that. You've got this rather awkward challenge, which is very, very real, associated with a greater desire for sophistication of data, but also at the same time, ease of consumption. And those two things are not necessarily mutually contradictory. If you think of an iPhone, for example, a smartphone of any kind, I've chosen Apple for fun here, but if you think of a smartphone, incredibly complicated piece of machinery, and the apps within it, just take any kind of maps application that you find on your smartphone. In order to track your location properly and accurately, it has to factor in Einstein's theory of relativity in order to accommodate for gravitational pull of the Earth or whatever it might be, in order to locate where you are. Incredibly sophisticated. And yet my kids, who are very, very young, one's a toddler, they already pretty well know how to use my smartphone pretty easily. So sophistication and ease of consumption are not necessarily mutually contradictory, but hard to do well. And you've seen this move of ESG data to be more fundamental to the investment process, rather than seeing as an interesting or alternative data set, but rather being integrated in a genuine fundamental way into investment allocation processes and models. Let's move on. I talked about the growth in assets under management, and you see in this slide that there's a real shift to the specifically in Europe, which has really driven that focus in terms of growth of assets under management. US somewhat behind, but catching up quickly, and Asia is further behind that. And I guess I would describe the fact that there's a growth in two areas. What we're looking at, the slides that I've shown you so far, is the growth of assets under management which are explicitly sustainability focused. They have sustainability as an outcome of the investment process. They are trying to drive, there's always been two vectors associated with whenever you save money and you put money into investments, risk and return, fundamentally, those are the two main vectors that we all understand. And if we ever put money in a pension scheme, and our IFA might ask us various questions, and essentially they're asking us various questions about our risk exposure and things like that, and they're wanting to understand our return and our risk profile. But there's a third one now, which is essentially what I might describe as impact. I don't want to be overly specific about the definition of impact for this purpose, but risk, return, and impact. How is the money being put to work, and is it supporting sustainable outcomes, or is it at the very least, at least not doing any harm, or doing as little harm as possible? So you've got the growth of assets under management, which focused on this sustainability outcomes, but you've also got, and this is where it gets really exciting and really interesting, you've got even just the rest of the 70% of assets under management which don't articulate themselves as being focused on sustainable outcomes in a direct and explicit way. They are also accommodating ESG factors and sustainability factors into investment allocation processes more and more and more, because they are meaningful for valuations. They are meaningful. If you want to understand, if you have long-term investments and you have investments which are planned, you don't want to do too much turnover of those investments over the course of a 10-year period, then over the course of the next 10 years, there will be a significant decarbonisation of the economy, as an example. And if you haven't factored in what that decarbonisation looks like and who is most likely to be winners and losers of that decarbonisation process, who's going to get left behind because they can't decarbonise fast enough, then it's purely a valuations issue. You don't want to be invested in the equivalent of Blockbuster video versus the equivalent of Netflix in this space. And so that's why even what you might describe as your standard conventional asset managers are starting to factor in certain elements of this into the investment process, not because they're necessarily trying to drive sustainable outcomes, but because the effects of the external world on companies are very, very real. If nothing else, COVID-19 has demonstrated that to us, right? So growth of ESG adoption is sort of super exciting for both those reasons. Let's move on. I've talked about climate change, and I won't spend too much time on this slide, but suffice to say that the chart that's in the middle that you can see is really focused on, that's the total carbon emissions, or total GHG emissions, and how it breaks out across all the different regions globally. And so you can see, of course, that what you might describe as the developed world, particularly the United States and Europe, make up a very large proportion of that, and certainly if you go back a few decades, made up the vast majority of that. But more and more and more, you're seeing this shift as, of course, when you get all the fantastic benefits of the growth of the economy in emerging markets, particularly China. I'll use China as an example, but it's certainly not the only one. The fantastic benefits of the growth of the economy there, and how that pulls, you know, hundreds of millions of people, in the case of China's case, out of poverty, but creates a flip side, a sort of a consequence of that fantastic growth and that fantastic prosperity and the reduction of poverty being so massive. The flip side of that is that as those countries industrialize, the carbon emissions increase very, very rapidly as well. And so a total shift in terms of how we actually drive energy production is what's required to reduce carbon. It's really important to understand the material impact of what really makes a difference and how you really change outcomes, and where capital needs to be deployed to in a very tangible way in order to foundationally change you know, what might be an otherwise rather untenable future. Let's move us on. Climate is, of course, one of the critical areas of focus, but one of the other areas of focus, if we get to the next slide, is, I guess this kind of touches on this issue of you know, what I was describing earlier about, it's not just about wanting to drive for social impact. It's also this sort of focus on recognizing that sustainability issues cannot be, I'm going to sort of quote someone from Bank of England who I think phrased this beautifully relatively recently, Sarah Breeden from Bank of England, actually, who leads the sort of climate stress testing team under previously Mark Carney. And she said, I'll probably slightly misquote her here, but the point of the crux of the point that she made was, it's impossible for financial markets to divest away from or diversify away from these risks. These risks are inherent to society, therefore they're inherent to the real economy, therefore they cannot be diverted away from by the financial markets. And hence why you've seen at the beginning of this year, massive corporations such as Microsoft pledging that it'll be carbon negative in Microsoft's case in the near future. You've got the CEO of BlackRock, Larry Fink, making a very, very clear pledge at Davos at the beginning of the year around the focus on making sustainability completely central to everything that BlackRock does and all of the investments they make, and all of the ways in which they manage capital. And you've even got, and it's worth pointing this out in the bottom right-hand corner, and there isn't, you know, by default a reason to be cynical about this, I should point out. You've even got then the very large energy companies, you know, particularly historically focused on oil and gas, such as BP, who have made significant pledges around getting to carbon neutrality. And that is very, very meaningful. If we look at the last slide, we don't need to go back to the last slide, but remembering the last slide and looking at the carbon emissions challenge and what that means in terms of, you know, allocation of capital, and actually how we source and provide energy in order to make the world go round, if you like, becomes very, very meaningful. And so when you've got very, very large energy companies figuring out how they themselves would go carbon neutral, and that's not straightforward, that is a total transformation of their business. It's an utter transformation. It is not, so to speak, that doesn't involve checking a box and doing a bit of PR. You have to totally foundationally change what that company looks like in order to get to that outcome. And why would you do that? That by definition carries so much risk that you are literally changing the entire nature of the company over the course of the next few decades. Well, you do it because the alternative is even less palatable. Because if you don't make those changes, then the company won't survive. As well as the fact that it would be massively harmful for the rest of us. Moving us on. I mentioned at the beginning of this that, of course, you know, climate is a massive theme within sustainable investing, sustainable finance. The other major theme is I guess I would describe as diversity and inclusion. And gender has up until now, up until recently, been the major driver of diversity inclusion focus in terms of focus on you know, looking at which companies to invest in and which companies are doing better as it pertains to gender diversity. There has obviously been a real focus in the last few months post the Black Lives Matter movement on race and ethnicity as well. And I think we'll see more and more data associated with race and ethnicity too when we look at diversity and inclusion. But certainly gender has been a central focus. And what's interesting is there have been a lot of studies. I highlight one on the left-hand side of the screen, but there have been a lot of studies which demonstrate a pretty strong correlation between greater gender diversity performance and greater financial performance in the long term between companies. It is less easy, it's not impossible, but it's certainly less easy to demonstrate where that relationship is causal. There's a correlation there, but what is the cause of that, which is the driver, if you like? That's less easy to establish simply because there are so many variables at play. But nevertheless, the fact that there's a strong correlation is reason enough to believe that companies with strong gender equality targets, and so who have made equal opportunity central to the way that they run their business, do tend to perform better over the long term, and that's worth paying attention to. Let's move us on. Very, very briefly, last couple of slides. If you can move on one more slide. Refinitiv tracks a lot of this data. Refinitiv has at its core a database of about 9,000 companies and growing relatively fast. Would be about 10,000 by the end of the year, focused on ESG data. So looking at 450 data points, or up to 450 data points on those 9,000 companies. And that represents about 80% of global market capitalization. And of course, then that data is used by investment managers to make all the kinds of analysis that we've been talking about in this presentation so far. And of course, we're also tracking all kinds of other things. And I won't try and be completely comprehensive in running through a big long list now, but it includes things like new sustainable financing which has come to market, so new bonds which have been issued which have got sustainable outcomes at the core, so whether that's green bonds or social bonds or COVID-19 relief bonds, that kind of thing. We're tracking that too. So lots and lots of capability that Refinitiv has around this space, but absolutely see ourselves as central to the process of creating transparency to enable financial markets to make better decisions which support sustainable outcomes. And if we go to the last slide now, this looks a little bit technical, and the screenshot on the right hand side of our page is from our product, our strategic desktop product called Icon. And really all I wanted to emphasize here is that whilst this looks a little bit technical maybe for some, for portfolio managers who spend their time essentially determining how capital should be allocated between different securities in order to drive the best and optimal outcomes, Refinitiv believes that you don't just want to service ESG professionals, the experts in ESG, which is still a relatively small, very fast growing, but relatively small proportion of the entire financial markets community. The trick here is to make ESG central to what even portfolio managers and your average investment bankers do, and make it tangible and useful to work with, so that you're empowering the allocation of capital, the creation of capital. You're enabling that process with the entire financial community. And so, that's really sort of central to how Refinitiv focuses on this space. And look, with that, let's, the last slide I think is just a placeholder slide for Q&A, but Vivian, I'm going to hand back to you now, and feel free to drill into any of that or anything that you feel that is interesting that I didn't cover.
Thanks very much, Leon. Actually, that was really insightful and sort of brings together the environmental thread and also I suppose the social and governance aspect of it, particularly D&I, which is something that we're focused on at Women in Banking and Finance, is about the impact of greater gender balance at all levels within our sector. And that impact is very positive, and trying to get that impact and that shift to move much more quickly. So thank you very much for your insights there.
I'm going to pick up as Vivian tries to join. I've managed to get pinged by the team on the chat function with a question, which is really, why has ESG grown so significantly? I think that's what Vivian was hinting at the beginning of her question, that there's been massive growth just in the last few years. What are the kind of critical drivers behind that? So with that in mind, look, I think that I'd started to touch on some of these, but I think that the kind of key drivers are you've got this just growing awareness, quite frankly, and growing expectation. There's just a much larger expectation on companies than there used to be, that companies reflect the values of the societies in which they operate. And as such, as you get more and more millennials, not just with savings, I mentioned that earlier, but actually more and more millennials who are taking positions of responsibility within companies, responsibility within all the types of corporations that they work in, whether that's in the financial market space or, quite frankly, if it's in the energy space or anywhere else. And they want those companies to demonstrate what purpose the company has, as well as the fact it makes great products. Is it clear about its purpose and how it goes about doing business? And so you've got this then focus from the corporate space, and there's massive pressure on the corporates from the investors. If you want to attract capital, if you want to attract shareholders, you have to be able to demonstrate that you're sort of meeting the values that investors themselves expect to be driven from you. And that is the reason why ESG data exists, interesting enough. It's worth pointing out, because a lot of the time there's a sort of a standard narrative, which is that shareholders are bad and they're all about short-term profits and so on and so forth. But it's actually the investment community which is the reason why ESG data exists on companies. There is no mandatory disclosure anywhere in the world just yet on companies to disclose ESG data points today. So the only reason the ESG data points exist is because the corporates are under pressure to disclose that to investors in order to be able to attract investors. And so, going back to the points I made earlier about both the growth of ESG investment strategies, as well as the growth of factoring in ESG considerations into just standard valuation strategies, both those reasons then start to drive why we see more and more ESG data in the markets, especially coming from companies, because quite frankly, companies can't expect to easily attract capital and attract investors if they are not responding and reporting on those things, and indeed not just reporting on them, but demonstrating progress and strategy around solving for them. So Vivian, I sort of covered for you there. It looks like you're back with us. I'm not quite sure what happened, but you seem to be okay, so that's great. I went through the first question there, which I think you were getting towards, which was the growth of the market. So if you're back with us, then fire away with something else.
Thank you so much, Leon. Absolute nightmare. I lost power altogether. We were just joking before the call, actually, of all the extraordinary things that happen in this new digital online world. And oh my goodness, it happened to me again. So thanks very much. So I think you've covered off why it's grown so significantly in the last few years. And I have to say, I personally have been quite surprised, because it makes sense, it's ethical, it's sensible, it's the way forward, but the level of momentum behind it and the fact that so many big names are actually moving in this direction is impressive. And I thought particularly that slide with BP re-looking at their entire business model it's a sea change. It's not it's just incredible. But it isn't all smooth sailing. So I suppose my next question is what are the problems and challenges associated with ESG investing or using ESG data in investment strategies? Is there enough stuff to invest in this space, for example?
So I think some of the challenges are, I think probably a couple of questions in there. The first is, what are the basic challenges of investing in this space or putting money to work in this space? I think the first thing is that I've already mentioned that there isn't any mandatory disclosure yet around ESG data. But when you go to an annual report from a company, you can be pretty sure, and it'd be very surprising if you couldn't find a cash flow statement, a balance sheet, a P&L, standards of financial reporting, if you like. And they might all look slightly different depending on the industry that the company's in and the focus and so on and so forth. But broadly speaking, you can expect to find those reports in any company annual report. There's no equivalent of that for ESG data. There's no equivalent of what standard good reporting looks like. There are companies reporting on various things because they feel under pressure from their investors to do so and to attract capital, but there's no standard mandatory reporting process. And that means that there's not a standard way to report any given data point. It's not like there is a specific methodology which everyone has to focus on when they're reporting their Scope 1 carbon emissions, for instance. I don't mean to imply that that means that they're all talking nonsense and all completely different from one another, but nevertheless, the lack of standardization doesn't help. And secondly, even the way it gets reported. Sometimes people do report ESG data in the form of tables and charts and things like that. But very often ESG data is captured within text. And in, you might find an individual data point within a very long paragraph of text with all the context and et cetera, that the company wants you to understand behind that, which, for the company perspective might feel appropriate. But in terms of actually then collecting, standardizing, normalizing this data set, and being able to compare apples with apples across all different companies, it's very, very hard when there's no regulation around this at this stage. So in that sense, it's still a very immature space. And as a result of the lack of standards of disclosure, both in terms of what the data points mean and how should they be reported, you've also got the challenge in the sort of sustainable finance space of there are different outcomes that different people want to drive. The first and most obvious is that you might be looking at ESG data from a perspective of impact, or from a perspective of risk management, or from a perspective of alpha generation, outperformance, effectively. And you might look at, in fact, you probably would look at different data points, depending on which of those you're trying to drive. The different data points will help and support those different outcomes, depending on whether or not you're just managing risk, whether or not you're generating alpha, or whether or not you're trying to demonstrate impact. Secondarily, of course, and we touched on this right at the beginning, that ESG is actually a rather awkward umbrella, or indeed sustainability as a whole is a rather awkward umbrella term for a number of different thematic issues. And again, a very genuine sustainable investor may, in one case, be more focused on climate and wanting to solve for that, in which case they're going to be very, very focused on a specific set of data points. And those data points may look very, very different that they're focused on in terms of the, what they're looking for from companies, than a different investor that's also focused on sustainable outcomes, but much more around the social side and things like diversity, inclusion, and human rights or employee rights in the workforce, that kind of thing. And so ESG as a single thing, or sustainability as a single thing, ends up becoming rather awkward, because it's really an amalgamation of a bunch of different very important thematic issues, which can't necessarily be traded off against each other, but necessarily some companies will be good at some of those things and less good at others. And by definition, if you only invest in companies which are fantastic at everything, you're going to have a very, very small number of companies to choose from. And indeed, that's probably not, the healthiest way to do it. I think it's also fair to say that there are multiple ways in which you can invest and do it sustainably. So even if you're trying to drive the same outcome, if you're focused on climate, some people might choose to not invest in carbon-intensive companies. Some people might choose to invest in carbon-intensive companies, but only in the best ones which are making the biggest and most progressive change towards decarbonisation. And others might choose to invest in carbon-intensive companies and invest in the worst ones, but in order to become activist investors and force change upon those companies. And all of those sort of that level of cognitive diversity and diverse approaches to what sustainable investing is, can be very, very useful. But it means that it makes standardization around what good looks like very, very hard indeed. And I think that's a challenge that the industry is going through around what does standardization mean in the context of sustainable finance and sustainable investing.
Thanks, that's actually a really good point. And I'm going to pick up on one of the questions that's come through on that, which is, how do you expect the framework to develop for ESG rating companies and their data products? Or to give it a slightly different spin, it sounds to me as if the EU is leading in the regulatory space in order to get firms to produce the data in a consistent format so that it is readily digestible. And where is that going? Do we need the regulation, or do you think there will be self-regulation that will take us forward in this?
No, I think the regulation is pretty important, and I think that it's one of those areas whereby self-regulation would be too slow to drive the outcomes that we need. So, I mean, the reason for ESG data to exist at all is as a result of self-regulation, if you like. But if you're just dependent on that, then it's not likely to move fast enough for most asset managers and institutional investors, and indeed, retail investors to be able to want to drive the right kind of outcomes. So if you want to drive those outcomes faster, then actual regulation is required, and certainly the EU is absolutely at the forefront of that, and is sort of taking the first leap, if you like. What the EU taxonomy, broadly speaking, doesn't do is it doesn't actually describe what mandatory reporting looks like around ESG data points as it pertains to the sorts of things that we've discussed a lot today, like carbon emissions and levels of diversity, inclusion, and targets around gender diversity and things like that. It's actually focused on OPEX, CAPEX and revenues that companies make, which are compliant with what the EU has termed as the green taxonomy. And I think that's super important too, because, you know, there's a lot of focus that, you know, you've heard in the markets and in politics over the last few years around the trillions of dollars that need to be allocated towards sustainable outcomes, particularly to solve for climate change and decarbonization, and the infrastructural requirements globally needed to do that. But it's very, very hard to measure how well we're doing against that. It's extremely difficult to know how much money is being deployed to that. We can, to a certain degree, look at new financing which comes to market, so new bonds which are issued, which are green, and, you know, things like that. Certainly, Refinitiv does do that, and we do track that. But that's not the only capital that gets deployed for the purposes of sustainability. So, for instance, how much is BP or Royal Dutch Shell or any other energy company for that matter? How much are they deploying towards sustainable outcomes and green technologies from their own balance sheet? Let alone the new capital that they raise from, you know, issuing a bond to market, but how much are they issuing from their existing balance sheet? And so the EU taxonomy has, I think, you know, a slightly different take rather than the sort of mandatory disclosure of the ESG data points that we've described, but no less important. And again, as I said, look, I think that the EU taxonomy will be the first piece of legislation in the ESG data space, but it's certainly not the last. But it's likely to be a driving force globally. I don't think it'll be adopted exactly in form elsewhere, but it will certainly act as a very strong framework at a global level. But don't expect that to be the last thing that happens.
Okay, thank you. That's really interesting that the EU is leading on the regulatory charge. Another question that's come through is actually about the impact of coronavirus and whether or not this has helped or hindered sustainable finance. Has it distracted us from ESG, or has it enabled firms to double down in this area? What are you seeing?
Yeah, interestingly, in my slide deck, you remember there was a slide in there where I used the term, you know, is sustainable finance about altruism? Or is it actually about long-term sort of, you know, a self-benefit, if you like? And there was a lot of discussion at the beginning of the lockdown, the beginning of the corona crisis, if you like, where there was a lot of discussion, particularly in the US, but not limited to the US, just to be clear, around, wow, all this focus on ESG is going to go away now, because now we've got life and death situation. And so we're not going to focus on that so much. And there was an expectation that there'd be a pullback from ESG. Now, I think that what we've actually seen is exactly the opposite to that, that the fund flows into ESG funds has actually increased. There's been a demonstrable performance differentiator in terms of companies that score well on ESG have demonstrated less volatility in the capital markets as a result of the crisis that we've seen economically. And money has continued to flow, and ESG focus has continued to be driven. I think there are a couple of reasons for that. One is that as the market has matured, there's been a better understanding that ESG is not just about altruism. It is not the same as sort of just the corporate social responsibility agenda, if you like. It is much more integrated and core to the strategy of companies than that. So if I use a rather crude example, and the example is by definition it's a bit crude, it doesn't quite work, but hopefully it makes a point, which is if you are struggling to put food on the table for your family because you're struggling to make enough money, and you're struggling to pay the rent and have a house over, you know, a roof over your head, then of course you're likely to pay less money towards charity because you just don't have enough free money. The more that you've kind of essentially, you know, solved all the major problems that you have, and you've got a house over your head and you're putting food on the table and you can pay your rent and all that good stuff, then you're more likely to give money to charity. And that was the expectation that a lot of people had around what would happen to ESG, that in a life and death situation, coronavirus, ESG would go away. Now, what has been proved, I think, relatively conclusively, is that actually most investors don't consider it to be ESG, and most companies who are really serious about ESG don't consider it to be altruism and don't consider it to be a nice thing that they do on the side when they've got extra time and cash. They have recognized it as integral to them. They have recognized that the risks associated with mass decarbonization, or if we don't decarbonize fast enough, then mass physical risk challenges against the operations of your business in the long term are not going away as a result of coronavirus. Indeed, what coronavirus has demonstrated more tangibly than we even really understood before, and what it's brought home, is that massive humanitarian and social crises cannot be avoided by financial markets and cannot be avoided by companies. There's no way of avoiding those things when they're on a mass scale. Now, imagine that you were able to actually predict with a reasonable degree of accuracy, predict, quantify, and time with a reasonable degree of accuracy the next major huge humanitarian social challenges. Well, that is the climate crisis. So actually coronavirus has sort of demonstrated we weren't able to predict coronavirus with the same accuracy of timing and impact and size and scale and all that kind of stuff. But if you were able to do that with the next crisis, if you like, which would be perhaps even more significant than the corona crisis, then by definition, you would act accordingly and you would start to factor into the way you allocate capital and the way you manage your businesses. And so this idea that ESG is altruistic, whilst it can incorporate a degree of altruism, I don't want to imply that altruism is bad here, but it is certainly more than that and is more integrated strategically than that in the way that asset managers are allocating capital, in the way that companies are running their businesses. Going back to my point about BP, and Royal Dutch Shell is another good example, but and there are others, but you wouldn't go through such an utterly transformative change to get to carbon neutrality if you're an energy business, unless the alternative was much worse. The alternative has got to be even riskier, which is if we stay as we are, we will not survive over the course of the next 20, 30 years. Otherwise, why would you do it? You're certainly not doing it from a perspective of a little bit of PR when you're putting that, when you're putting essentially the existence of the company at risk by going through such a transformative change. And that, I think, helps demonstrate the centrality of sustainability to a number of companies and to the investment community.
Oh, that's actually really interesting, isn't it? Because I think sometimes we think that these crises are far off in the distance, and perhaps coronavirus has helped us to refocus that they can happen today, here and now, and the impact is so huge. And so actually this isn't something we can push out to the future. It's something we need to deal with right now. Here's another question for you, Leon. What would be the 3 most useful resources or tools for investors that are seeking to set targets and to track progress on sustainability outcomes?
What are the 3 most useful tools?
Resources or tools for investors that are seeking to set targets and track progress on sustainability outcomes.
So look, I think probably the first thing is that there's a couple of things in there. The first thing is, of course, that by definition, you need what is needed in the markets generally is transparency. Look, I would make the case that Refinitiv, in its various different guises, previously with Thomson Reuters and before that Financial and Reuters, has driven transparency to markets. That is the raison d'etre and a core sort of existential reason for Refinitiv to exist, is to drive transparency into markets. And this in some sense is no different. You can't optimize capital effectively, either as an asset manager or as an investment banker or as a retail investor, or as just someone managing your pension. You can't allocate capital effectively if you don't have transparency into what's going on. And so greater and greater data is completely central. More and more data is completely central to the process. And with that in mind, I think that Refinitiv and others similar to Refinitiv are making a very strong push into this space by actually just driving more and more data into this space. And by having more and more data, they also act as a stick and a carrot to the rest of the community to create more data, if you like. So it's sort of self-fulfilling in that journey. As immature as it is right now, it's self-fulfilling. I think that there's a critical point that I'd like to make here, which is for any investor, I've already hopefully problematized the process of what it means to be a sustainable investor. It's not actually straightforward, and being sanctimonious is not particularly useful. Actually, it might get in the way of really productive outcomes. You need to establish what your focus is. You need to be clear about what outcomes you're trying to drive and the order of importance of those outcomes. Are you trying to manage risk? Are you trying to demonstrate impact? Are you trying to generate alpha? Are you trying to do any combination of those 3, either 2 of those 3 or all of those 3? Are you primarily focused on climate? Are you primarily focused on diverse inclusion? Are you primarily focused on resource usage and recycling and things like that? What are the things which are most meaningful for you? Because if you don't actually establish that, then sustainability is always going to be this rather, even if the data is fantastic and it's completely comprehensive, if you don't really establish your own sustainable investing strategy, you're never going to be able to make sense out of the data, because by definition, the world's a bit complicated and you would need different types of data to drive those different outputs that I just described, which means that you have to be extremely clear about your own sustainable investing strategy. You've got to shoulder the burden as I would describe it, as establishing what your own sustainable investing strategy is. Stand behind that, make that part of how you invest, make it part of your models, make it part of what you, of who you are. And once you've established that, then establishing what data you need in order to support those outcomes in terms of what you want to measure and what you think correlates well, starts to become easier because you've already narrowed down this audience of enormous amounts of data and enormous amounts of direction that you can move with the data in order to make much better sense of it. You know, I've talked a little bit about the data. I haven't really talked so much about the scoring and the ratings of ESG, and I don't intend to get into that, you know, that wormhole now, if you like. But nevertheless, you know, there's a reason why ESG ratings, which are often, it's often been dismissive that they're all so different from each other. But given what I've just described about the complexity of the space and what outcomes you're trying to drive, and that no one really agrees on a standard as to what sustainability means, and legitimately, I would argue it could mean different things to different people, then is it any surprise why the rating agencies might then differ? But that then has an obligation of understanding the rating agency's criteria, their methodology, and how well that matches to your own and your own sustainability agenda, your own sustainability strategy. So look, I sort of spoken a couple of riddles there. I don't think I answered the question very specifically around the 3 areas, but I think that once you get past the drive for transparency and data, what you then do with the data is very much specific then to what outcomes you're trying to drive. And I think then that becomes a much more specific conversation with an individual investment house, if you like, around what they want to achieve and what are the best tools to do that.
Okay, thank you.
I slightly diverted away from the question there, but happy to pick that up offline with whoever answered that and you know, perhaps be more helpful to their specific situation.
Fabulous. I think we've got time for one more question before we wrap up. And this is sort of the proof in the pudding question, really, which is, are we seeing correlations at this stage between ESG investing and financial performance?
Look, the answer is yes. But you can see I've said that with a kind of a slightly quizzical look on my face, as if I'm sort of preparing a caveat here. And that's true, I sort of am. So the answer is yes, you can see, and we have seen, we've done a number of pieces of analysis that correlate ESG performance to returns. Quite hard to demonstrate causality as opposed to just correlation, because of course the variables that might contribute to performance are numerous and may not only be ESG related, but there is good evidence that there is correlation there, and a number of studies have started to demonstrate that. Why am I quizzical about it? Well, one, because the causality issue seems to be an important issue, which is much harder to unpack, so I think there's still more work to be done there. But 2, because I'm a little bit, as you would have heard in this conversation today, I'm a little bit cautious about implying that ESG is one thing. I actually think that you need to break ESG down into its component parts if you really want to understand correlations to performance, into, you know, issues such as diversity, inclusion, resource management, employee rights, climate, you know, those types of things, that you need to break it down into those pieces to really understand the data points which correlate and identify how you would isolate those data points. Treating ESG as one thing is a rather awkward amalgamation. And you're going to find in certain situations there's correlation, in others there isn't, because by definition, you know, you're taking very complex subjects and you're simplifying it into a very simple thing. It's not quite the same thing as a credit rating, which is designed specifically to answer a very simple question. E rating is something slightly different to that. So, you know, the answer is yes, but I think there's more work to be done there, and I think there's more sophistication that's needed in the market to really make sense of that. I guess the final thing I'd say on that, which I think I intend to be a useful comment, is that you've got to remember that some of the risks associated with what ESG is trying to identify, I've spoken a lot in this session about the climate risks, you cannot regression and back test in the way that you normally would with any normal risk model in order to establish what those risks look like historically. That's why there's so much focus around ESG data, particularly around carbon emissions and transition risk and physical risk associated with climate, on scenario building, on articulating what scenarios might look like based on different levels of climate change, different levels of global warming. And that's because you can't backtest, because those things didn't happen before. It didn't happen 10 years ago. It's going to happen, and the risks that you want to manage against are forward-looking. They're not backward-looking, which is new to a very large degree to the financial markets industry, which are used to looking at risk management as a historical analysis process. And so by definition, you wouldn't necessarily expect, I don't think, that there'd be a strong correlation between the effective management of carbon emissions historically and financial performance, because you're not managing to the history, you're managing to the future in that scenario. Doesn't mean it's any less material, might be very material, might make or break your pension fund, quite frankly, as to how you've invested that over the next 10, 20 years. But you can't just regression test and back test around it. And that's a new challenge for the institutional finance audience.
Fantastic, thank you. I've got a few minutes left, and there's just one other question that has popped in, and it may not be an easy one to answer. I suspect it'll be based on the facts, but somebody's asked, they're interested to hear your thoughts on Boohoo. I haven't seen this article, but Boohoo apparently has been highly rated in ESG terms, but in the last few days, they've developed a significant number of issues with their supply chain labor standards. So just interested in your thoughts on that.
Yeah, I think there are really a couple of really important things to point out, hopefully which will resonate based on some of what I've said already. The first is that there's a specific problem that has been identified with Boohoo, which is in the employee rights in the supply chain. That is not the same as overall ESG. Their carbon emissions, by the way, I'm not stating that carbon emissions are great. I'm not looking at the data, right? But their carbon emissions might be great. The levels of diverse inclusion in the actual workforce that they control directly might be fantastic. Could be all kinds of things that they do really, really well there, which means their ESG score is appropriately reflecting all of that, all the good stuff that they do. But in their supply chain, which is essentially not the people that they employ directly as employees of Boohoo, but no less important, I'm not undermining the point, in their supply chain, the companies that they hire as suppliers, they've clearly got some very real problems there. And there comes this issue of the growth of data that's needed. It's not just data about individual companies, it's the relationship between companies. And of course you need data on private companies as well as public companies, because of course you've got private companies which are suppliers to public companies. So to understand the supply chain well, there's an enormous amount of data which is required. And that's why I think regulation has a very important role to play there. So one is that ESG treated as one thing is not necessarily a really good indicator of a specific issue, such as the employee rights issue. And secondly, that you've got a specific issue there of it wasn't really an employee rights issue within Boohoo employees themselves, it was in the supply chain, which is super important, highlights the need for better data, highlights the fact that it's still an immature space. I don't think it undermines entirely ESG data in its current form, but it does identify the need for it to mature further. And that's the journey that we're all on.
Fantastic, thank you. So Leon, that was absolutely amazing. And I'm going to attempt a wrap up. So you started off by clarifying that there's sort of two main themes that, as you see them, one of which is around financing the decarbonizing of the world, which is, I suppose, what I often focus on. And then the other one is more of the social piece, which is about driving emancipatory values so that we can have a much more open and transparent society. And that's where a lot of the D&I fits in there, which is fantastic. We talked about, is it a push versus a pull? It's actually a bit of both that's actually driving the change. We talked about the impact of coronavirus. Actually, this isn't a would be nice to have. People are understanding this is a critical business issue. So it's definitely very much here to stay. And then we talked about the complexity around ESG. That there is not sufficient transparency yet. The data is it's not necessarily in silos, but we have data about certain things and the data can be different and it's very difficult to pull it all together. So it's not like credit scores. And it also depends on what you're actually focusing on. So, it could be risk, it could be output, it could be input, it could be all sorts of things. But I think when we talk about ESG, because it's such a big umbrella, that actually there's an awful lot that it could mean. But the long and the short of it is that it's here today and we're making progress down this journey and it's really important for us in lots of different ways. So I think it's been terrific actually to hear from you today with some of those incredible insights. And thank you for answering some challenging and some difficult questions as well. Before we go, I just wanted to say thank you to everyone for participating and for your excellent questions. And we'd really appreciate your feedback. So if you could go to menti.com, we've used that before, and use the code 890051. If you just log in and then you can tell us how you felt about the event. I know that Leon, it's also been a request if you wouldn't mind to share some further information after the event today. So I will kindly ask him to do that. I think he has a couple of things to share with us, which is absolutely fantastic. And then I just wanted to alert you to a few events coming up. We don't tend to hold many events in August because a lot of people are on holiday, but we do have 3 outstanding events coming up. On the 6th of August, Culture and Conduct Risk, the regulators' expectations and current areas of focus. On the 12th of August, I'll be in conversation with Michael Cole-Fontaine as part of our Distinguished Speakers series. And on the 3rd of September, we've got the New Leadership for a New World, Authenticity, Self-Expression and Connection, and you can find all of those details on our website. And then the final piece is just to mention our Accelerating Change Together research program, which we have just launched. It's a multidisciplinary 4-year cross-industry project. The first year is focusing on the missing middle. The founding sponsors have now been established and we are starting the research, but we still have some sponsorship opportunities available. And if you'd like to find out more, please do email our operations team for further information. So with that, I think I'm ending at 2 o'clock on the dot, which is what I promised. But thank you very much to Leon, and thank you to everyone here today for engaging in a hugely topical and interesting discussion on what is ESG, the future of ESG, and I think we all need to be a part of it as well. So thank you very much. Bye-bye.